Hello again, everybody. We finished a couple of things. Our first video was we finished a couple of things. Our first video was terms and concepts. Second one is just a general talk about the types of financials and the types of accounts and things like that. Remember that all of that discussion was just trying to say, here's an aggregate of information. For me to understand it, I need to break it down into some meaningful components. And so the belief is that financial statements offer you that kind of meaningful detail that can help you understand the story behind what the business is doing. So I picked a company. I just picked the Cheesecake Factory. They are a publicly traded restaurant, obviously, and I like cheesecake. So, although I do have trouble with their menu because it's almost heavier than anything I can pick up. But nonetheless, this is the balance sheet. Okay. You might recall that I said there were components. So they'll talk about this as a classified balance sheet. Um, that's much more kind of sophisticated than I want to be, but just to demonstrate I know stuff. It's a classified balance sheet. You'll notice we talked about current assets and we talked about those things that are longer term. The current assets, we said these are kind of the categories of importance. So we've got this that we already identified. We talked about inventories. That means that income tax and other receivables and prepaid expenses, those things were kind of lumped together and would show up in my other current assets. So that is a fairly consistent approach. In this case, these items were big enough, I suspect, for the accounting firm to want to disclose those. So it's kind of unique that they would have an other receivable of that size. So in terms of the story, I'd want to find that out. Next thing, property, plant, and equipment. Okay, when I think about the Cheesecake Factory story, they probably rent a lot of those spaces because you see them in malls, you see them in those kind of spots, and so they may not actually own the building. However, they put a lot of stuff into the building. So that can be property and equipment. Okay. So if they improve the space, that's going to be property. It's a leasehold improvement. And so the story tells me they've got quite a bit of, of property, plant, and equipment. So the total assets they have of $2.8 million, not quite, I mean, they're not quite $1 million is going to be made up of property, plant, of property and equipment. Okay. The next thing that you come down to are these other assets. Okay. And they've got intangibles. Okay. Probably comes from acquiring other restaurant groups. And so you might hear something called goodwill. That's the extra amount paid to acquire an entity above the cost value of the assets that you acquired. It's because you see greater value there than might be just in the hard assets. Prepaid rent, you might think about that in terms of, okay, I may pay early for um, the rent that's coming up. Now, you might also remember that when the pandemic hit, Cheesecake Factory made a big marketing issue. They were going to continue to pay their landlords, and so in fact they may have paid them early, and that may be just a regular operating approach that Cheesecake Factory has to get better pricing. If I go in and say, I'll pay you a year at a time for rent if you'll give me a better rental price. So based on that, they've got these things set up. Operating leases, that is going to be the rent that they have on all those facilities. So between this 8 and that $1.2 million of the 2.8 is sitting there in facilities. Investments, got some investments. And so these are things that we've already talked about. If we move on and take a look at the liabilities and equity side, nothing really surprising here. These are all still the same thing. The only thing that's out here that's kind of unique is this gift card liability. That would be the same thing as deferred income. So that's why they say gift cards are only good for a certain period of time. because they want to be able to convert this instead of an obligation to customers just straight into revenue. So they don't have any other obligation to provide that service. Accounts payable, as we talked about. We got all of this stuff in here. Okay. This tends to be really hard to understand. And I think it's generally beyond the scope of what I'm trying to do, except for that one item, long-term debt and long-term leases. Sorry about that. Should have had them both. Those are the two big ticket items that we have. The reason that this is so big is they changed some of the leasing requirements in terms of disclosure. This one is always unique because it's commitments and contingencies. It always has a blank here. It's all about lawsuits. You know, why is the company being sued? What kind of potential contingent losses do they have? And finally, you get stockholders' equity. Okay. And we talked about all of these pieces, and they just happen to be here, except for this one. And that one, this accumulated comprehensive loss, that is such an esoteric accounting thing. That is the last time I shall speak of it. When we go from there, we head over to equity. You'll notice that what they're trying to do is connect what has happened between the start of a period and what's happening at the end of the period. So your account classifications are across the top. And so what we have over here, there's the shares outstanding. Here's the additional paid in capital and so on. Additional paid in capital is kind of a unique piece because common stock has something called a par value. And the par value is just a legal number that they put on a stock. A lot of times it's just the par is $1. Okay, for no apparent reason. It's an old legal tradition. So if you pay anything above the par value, that's additional paid in capital. So anybody that's doing an IPO, okay, when they talk about the price they were able to get on their public offering, that price is going to be, they hope, substantially above the par value, and all that's going to result in additional paid in capital. You'll notice that here's treasury stock. You know, it's reducing our equity, and then there's the dividends. You can always find those as well. And there's the income piece that gets added and links the income statement to the balance sheet. And with that, the next thing on my list is the income statement, but we'll do that in our next video. So thanks for playing, and I'll talk to you again in just a little bit. Thanks so much. See you soon. Bye.